Good evening, everybody. All right. We get an excessive amount of inquiries about trading options. And the methodology on how to trade options are very different. Meaning, what you do as far as your risk-reward factor is up to each individual. But a lot of individuals don't know what different strategies to use to kind of fit into their risk-reward factors. So what we're going to try to do tonight is kind of give you a fairly broad spectrum of the different aspects of how to trade options successfully and how you line up for the best option trades. So there's going to be a lot of factors that we're going to look at, but what it boils down to is each individual has to decide on their own what they want to do to create their own successful trading based upon their risk tolerance and how much time they can spend analyzing trades or factoring how to put on an option trade. So this all comes down to the same scenario that we would use for analyzing anything, meaning what positions are we looking for? And are we going to be going into the position at the right time? So obviously the first factor that we should be considering is which direction is the overall market heading? That's the market trend. Then the next factor is, obviously, if we're looking at an uptrending market, we're looking for the patterns or signals that show us the best bullish trades. On the other hand, if it's a downtrending market, obviously we're scanning for the best bearish signals or bearish patterns. Now, when we find that, a lot of people say, well, do you buy and sell your options based upon the price of, Richard, I have no idea. I forgot what I was saying. So the extra element, a lot of people say, well, do we buy options based upon the option price? And the answer is no. Options are just a method for getting leverage to buy the underlying trading entity, excuse me, or the underlying stock. So if we see a stock is going up, that doesn't necessarily mean all you need to do is buy the calls, because we've got other factors, such as how much time do we have for the expiration that we're looking at? Is there an appropriate entry confirmation or anticipated entry confirmation? And then the final question is, which options? If we're looking at a $50 stock, do we want to buy the at the money $50 calls, or out of the money, the 55s, or in the money, the 45s? And so that all stems back to what is your risk factor. Now, I've got different parameters, which these are my parameters, but they seem to work. If I've got 4 weeks until expiration, and now remember, each person has their own strategy or their own criteria for which options to be trading. I don't have time, because I've got so many other things going on, to be watching very short-term options like the weeklies. So I'm usually figuring out, all right, what is my risk reward factor buying the monthly calls? And the monthly calls expire on the third Friday of every month. So if I'm buying, where are we? March. Tomorrow the March options expire. Tomorrow's the third Friday of the month. So if I like something tomorrow, I'm not going to buy the March calls because I only got one day. So that means I'm going to be going out to the April calls. Now, if somebody is a little bit more aggressive, they might buy the weekly call. Not this Friday, but the calls that expire next Friday or 2 Fridays from now. I don't know why you do your clicking noises. Sound cannot be any better? All right. It's this rich movie star type voice. If I have a shorter time frame, I'll flip over to maybe doing a debit spread where I'm buying the 50s and maybe selling the 55s. And we'll do a session on that some night, what the advantages are. Or if I'm doing a credit spread, which means I'm putting, they're wiretapping us because this is information that might be national security. If it's only like 1 week to expiration, I might do a credit spread, meaning I'm putting money in my pocket, but it's very short term. The amount of money that I put in my pocket may be very small, but the percentage probabilities based upon the candlestick chart tells me that the probabilities are extremely strong that I'm going to make that little bit of money. So there are different strategies. If you're going long, one is you can be buying the calls. How do you decide on a debit or credit spread? Usually on the time frame. But if I've got 2 or 3 weeks to go to expiration, I'm more than likely going to do a debit spread. If I've got 1 week to expiration, I don't want to have the price move around very much, I'll probably do a much shorter time frame and do the credit spread. So if I'm going long, that means I can either be buying the calls or selling the puts. Now remember, selling the puts is opposite than buying the calls, or it's the same as buying the calls. You're not buying the put, you're selling the put and putting that money in your pocket with the idea that as the price goes up, the price of that put goes to zero, so the money you put in your pocket stays in your pocket. You can be buying call spreads, or you could be selling call spreads. So these are all different strategies that, like what we've been projecting or training here in the last few weeks, is you don't have to learn 9, 10, 12, 15 different strategies. You might learn 3 different bullish strategies until you get those well mastered, and then you can start moving to another strategy. But the more involved the strategy, obviously, the more time it takes to calculate it and put it into place. But that's one of the reasons why we've got different avenues for people to learn which strategies they want to use. We've had in our option trading room, we've had Michael Tomset for the last year. Very conservative, but teaches very well what strategies to use. We're getting Bill Johnson to come in, who's much more aggressive and has many more different perspectives of which strategies to use to make money. So what we want to do, based upon candlestick signals, is if we see big gap type patterns or big breakouts, what do we want to do? Now, the advantage we have with candlestick analysis is we've got a high probability of identifying which direction the move is going. The biggest factor is the timeliness of the move, seeing exactly what type of signals we have at support or resistance levels that are going to provide a good trade immediately. So you're not sitting in a trade for 1, 2, 3 weeks hoping that it's moving in the right direction, but as you're waiting to see if it's going to move in the right direction, your time premium is decaying on you and not producing as good profits. And then we also want to find patterns that not only are going to tell us which direction, but which ones sort of tell us what magnitude of move we're going to have. So not only do we have to worry about as far as the time factor of an option trade, but we got to make sure that it moves a substantial amount to get up above whatever premium you had to pay for that trade, as well as make money in a specific time frame. So it's got to be a much more relevant move during a specific time frame, not just an uptrending price move. So the biggest factor is how much time do we have to expiration. So one of the benefits we have using candlestick signals is we can see what strength is coming into an option or a potential option trade based upon a candlestick signal and a gap up. That provides a much stronger analysis. So whenever we got the advantage of knowing that if we're buying a slow curve pattern, that we've got a high probability breakout situation that's going to do one of two things. If it fails, we're back out of a trade that we may have bought options right here with a small loss. If it works, we've got a big, huge gain. Or if we see the next pattern set up, we know exactly where the timing is to be buying it. But if this is our little scoop pattern, that if they gap it up through the resistance level of this scoop, we've got a good probability of buying, where a lot of people say, oh, I'm going to wait to see if it pulls back, or I don't want to chase after this one. We know exactly what it will be doing based upon the move after a chart pattern. That's why we recognize different signals and patterns. There's our slow curve. What's our slow curve telling us? We're building up. And notice where the doji sandwich occurs. Right smack dab at the breakout level. So the more pieces of evidence that we can put into our analysis, the higher the probability we're going to be not only in a right trade at the right time, but in a substantial trade at the right time. So one of the major factors that we have going for us in candlestick analysis is we can see the patterns that we know work consistently or with a high degree of probability that it's going to be moving in the right direction. We'll be happier than pigs in doo-doo if it moves up like this, but knowing what patterns like the slow curve, JHook Breakout, we've got the possibility of a big, huge price move, which obviously moves your option price very quickly and substantially. So the more pieces that we can put into our analysis, there's kind of our kicker signal gap up. That's a very forceful trend reversal, telling us we've got the probability of a strong uptrend. Or there's our slow curve again. If we were buying here, where's our next target? Up here at the 200. So not only can we analyze what the pattern might be setting up to give us a strong move, we can pretty much calculate where our next target will be, which gives us two opportunities. One, puts us in the right trade at the right time, but the right trade may not be buying calls. Let's say this is 2 weeks before expiration. It might be much more beneficial to be buying one set of calls here and selling another right here, that being the obvious resistance level. So the percentage return based on that spread is going to be much larger than just buying the calls outright. We will do a session on spreads. I use spreads quite often. There's three major benefits to a spread. One, you've got less money exposed. Meaning if you're buying a, I don't have the examples here to show, but you've got less money exposed. You've got a bigger percent return based upon that money exposed. So let's say, for example, you bought a call. I still should do this. If you bought a spread, you might have $2 in it, and you can maximize at $5, so you make 1.5 times your money, but with a high degree of probability and less money exposed, versus just buying the call outright, where that stock price may have to move 5 points to make that 1.5 times your return. If you just bought the calls outright, that stock price may have to move 9 points to make that same rate of return. Brian, yeah, we'll do some sessions on the spreads in our Wednesday night sessions. So the number one advantage we have is identifying what patterns are setting up so that we can be buying at the appropriate time. So my rhetorical question always is, does every pattern breakout give us huge instant profits? The answer is obviously no. But the probabilities of being in one of those type of moves expands dramatically based upon being in the right place at the right time. So anytime we can see something that's an obvious breakout of a pattern, remember, when we're buying the signals, we're usually buying when the signal is in the oversold area. When we're buying a pattern breakout, stochastics are usually up here in the overbought area. So a lot of people, I say a lot of people, I've heard so often in the past people saying, or investment advisors say, stay away from the gaps. You don't know what they're doing with the price when they're gapping it around. Candlestick signals and gaps are going to make you a huge amount of money, because if you understand what each signal represents and it's followed by a gap, it pretty much tells you if they're coming out of a pattern and they gap it up, what's that tell you? There's a completely new investor sentiment in this price move. Also, while I'm here, a lot of people want to say, well, what's the delta? Is this worth, what stocks do you look for delta? Trading candlesticks, delta, any of the Greeks are irrelevant. Because what do you think the delta is that has developed for the last X number of months based upon this price move? It's not very much. So that delta has absolutely nothing to do with what this new price move will be coming out of that pattern. I'd say, yes, I did. 3 benefits. 1, you have less money exposed. 2, you have a much less price movement to make much bigger rate of return. And 3, your break even is much lower. So, for example, just throwing out fast numbers, if I bought calls on a $50 stock and those calls were at $3, that stock needs to go to let's say I'm going to say, just pick out a round figure, $58 to make the same amount of money as if I had bought the 50s for $3 and sold the 55 for $1. I've only got $2 exposed. So that means my upside doesn't have to move nearly as much to make the same amount as buying the calls outright. And then 3, my break even is much lower. And just as a simple factor, if the stock is trading at 50 and I buy the calls for $3, my break even is at 53. If my spread is buying those for $3 and selling $1, so I have $2 invested, now my break even is at 52. Where can we find for rank? I don't know what that means. Oops. Jay, I can't, I can't help you there because I've never used it. Would you consider downside protection? Well, that comes with, yes, the spread is how you have less money exposed. You have less money exposed. You've got much bigger percentage upside potential with a much smaller price move, and your break even is much lower. Oh, implied volatility? I don't care about implied volatility. Because what was the implied volatility based upon this move? Not very much. What did the pattern tell us? That this is the type of move that we were going to have. So the Greeks mean nothing as far as the candlestick patterns. So what we're looking for is that major change of investor sentiment. What's our high probability entry when they gap this up out of this flat trading range? If they open a positive after an inverted hammer type signal, what's that tell us? The bulls are still there. We probably got a strong price move. So one of the functions, the first function that we want to learn is which patterns produce the probabilities that we're getting in at the exact right time. And when I see a pattern like this, like the T-line or the T-line crunch, and kind of a breakout through the 200, that even if I use this level right here as the breakout, that implies that the investor sentiment buildup, kind of this fry pan bottom, gives me the prospects of having a huge price move. So what's my risk-reward pattern for trading the pattern? Or trading patterns? Is if they work, I'm going to get huge gains. And they work quite often, otherwise we wouldn't be looking at the patterns in the first place. And secondly, if it fails, we're out with a very small loss compared to what our gains would have been. Oh, okay. Yes, so if that's their ranking system, yeah, it doesn't really apply when you're when you're using candlesticks. Now, it may already be built into your candlestick analysis, because which sectors are usually going to be the ones that produce the best candlestick patterns or the most prolific patterns? The ones that you already have the higher volatility built into it. Yes, Sockman, when it fails, that's the whole point. If we're analyzing candlestick charts, it's because we expect a price move based upon that signal or pattern. If it fails, it's because we can see that there's been a candlestick sell signal right at the breakout level. Tells us it didn't break out, close out that trade. So that is part of that sage advice that most money managers give you, that say, cut your losses short and let your profits run, but they never tell you how to cut your losses short and let your profits run. Candlestick analysis is just common sense, if-then analysis put into a chart. If this opens positive and breaking out, this is our expectation. If it opens positive and closes back here, doing a kind of a sell signal at the breakout level, it didn't break out. Close out the trade immediately. Which delta do you get? Oh, I don't know what that means. I don't even pay attention to the Greeks, because if I'm looking for a candlestick pattern setup, the delta, gamma, theta, everything that was involved with this price movement has nothing to do with this price movement. All right, but again, if you want to go after high beta stocks, you can do that. But that's already going to be built into your candlestick charts of which ones move the best. So if I know what pattern I should be looking at, or what the results of that pattern is, that if this is my downtrending resistance level, and I've got a wave 1, wave 2 JHook pattern, what does wave 1 and wave 3 equate to? The fact that they probably are going through this resistance level. So what do I watch here? I stay long, but if it fails here at this level, I close it out, because that tells me the resistance level is still in effect. If it gaps through, what's that tell me about my resistance level? It's not there anymore. CB, that is, again, up to each individual, whether you're going to buy in the money, at the money, or out of the money. And I'll show you different situations on that. So, again, look at the breakout of this little downtrending channel on a gap up. And look at our little scoop that gapped up through this level. What do we expect coming out of a scoop pattern? Usually a strong slingshot effect. So a lot of people, and I say a lot of people, and I say a lot of people that used to be me, a lot of people don't want to buy or chase a stock. And what's their philosophy? Oh, this one looks good. I'm going to wait for it to pull back so I can get into it at a better price. So, what's the logic of that? If you have a candlestick buy signal, what do you expect to see? Strong buying. If it opens and it's pulling back, what's that telling you about the strength of the buying? It's not there. Why do you want to be buying a stock that you should have a strong breakout pattern that's not showing good strength? Number one. Number two, what's it say about your clever decision-making process? It's saying that if you see a good move and it pulls back to let you in, that you've got the immaculate inception that as soon as you buy that position when it pulled back, it's going to turn right around and head straight back up because you were smart enough to buy it on the pullback. That's wishful thinking. I would rather be buying into strength, confirming my signal, telling me that if I'm looking at this and I say, oh, this is setting up for a scoop, if it breaks out through here, I want to be buying the calls because I know the expectation of what should be happening coming out of that price move. Or, where's our bobble expectations? There's the failure. Notice how it failed. When we came up from a buy signal down here, closed above, eventually above the T line, and what did it do when it hit the 50? It did a shooting star signal. Was that a strong signal when it hit the 50? Obviously not. That told us it's probably getting time to take profits. Now what happens the next time it comes up through? That's our bobble breakout. So we can be buying right here, knowing that it's come up through the resistance level a second time, doing a bobble breakout. And what is a bobble breakout? It's a much more defined JHook pattern with more clarity as far as where was the resistance level, where was the support level, and where did it break through the resistance level again. Is that at the money? Has delta of about 0.5? All right. Well, most people buy at the money or out of the money. Why are they doing that? Because they want to get as much leverage as possible on a trade. But the risk-reward factor sometimes doesn't work unless the trade actually works. So you want to figure out different strategies where you might put on a spread. And I'm just picking out numbers. You have stocks at 50. It looks like it's got a strong up move potential. You might buy the 50s and sell the 55s, and then buy the 57.50s at a much slower price. So if it moves up somewhat, hopefully you've made enough money on your spread to cover the spread cost and that wee little purchase of much higher prices, so that you've immediately or hopefully covered your cost of that trade. Okay, where are we now? So anyways, a JHook pattern, more defined, is a bobble. So not afraid to be buying here, even though our stochastics are showing we're in the overbought area. Remember, we're not buying stochastics. We're buying the pattern. We're buying the breakout. We're watching for the pattern setup. And if I'm buying options, look where our little resistance level is. And look what happened right before that resistance level. Our doji. So if we add the fact that we can see a JHook bobble type pattern setting up and it did a doji on this day and it didn't break out, what's our analysis for the next day? If it opens positive, what's our doji rule? Probabilities are that it's going to be a positive trading day. And if it's a positive trading day, what magnitude? Usually this right here or a doji sandwich breakout telling us our pattern is breaking out. So the more, again, more pieces of evidence that we can put into our analysis that we're in a positive trade, the higher the probabilities of not only being in the right direction, but in some cases being in a right direction with big price moves. Yes, over in our option trading room, that conversation is more directed toward option terminology, obviously. And we've got good traders in there, like Nora. And I'll show some of her trades. And it's based on the candlestick anticipation that if the trade doesn't work, you're out with a very small loss. If the trade works, you've got huge explosive gains to the upside. Okay, let's see what else we got here. Okay, so the breakout gaps pretty much tell us there's a definite change of investor sentiment. And what do we expect after big breakout? We expect that 45 degree. So now we can put in different strategies based upon expecting a 45 degree and how much time we want to allocate to that trade, whether it's a weekly or a monthly. So there's a lot of times we want to know what to do on a big breakout. Again, the breakout is telling us there is a new factor in this trading. Then look at our little Morningstar type signal. What's that tell us about the T-line? They aren't selling it off. There's still more upside. So the rhetorical question always is, if you're buying stock or options right here at the $15 level, you get these type of price moves where it goes up to 45, 50 in 2 or 3 days? Definitely not. But when you're getting into something like this, the probabilities of being in that type of trade are tremendously in your favor. So we are consistently watching for the big price move setups. But if we can see a pattern setting up, we're looking at the area that tells us this is the breakout area. That's where you want to start buying. If we're looking at trend channels. We're looking for the breakout area. So if we see something like this, what are we looking for? Stochastics, that's that out of place. Stochastics getting toward the oversold area. We're waiting to see when the next breakout is occurring. We can identify wedge patterns. Why? Because we know if we start seeing buying and they break through the top of the wedge, we've got big upside potential. Same scenario on the downside. If we see wedge formations, and there's our bearish best friend, doji gap down, what that tells us about the wedge? That's the direction they're sending it. So this is what the Dow is doing right now. What's that tell us? Pretty much tells us, even though the Dow was up 115 points today, we're still kind of in this wedge formation. What's it tell us about the force one way or the other? Right now there's really no great force one way or the other. It's just kind of in this sideways up and down mode. What are we looking for? Either they break it to the downside, which means we go heavily to the short side, or they bring it back up through here and start the next wave up, we go heavily on the long side. So if we're looking, let's say hypothetically this starts moving up here and we see a pattern like this, there's kind of our JHook with a doji right here on the 200. These are your high probability trade setups. If this opens positive the next day, what can we assume? Number one, we can assume that it's going to move in the direction how they open after a doji, which means they're trading positive. And two, if it moves the same magnitude as this, creating a doji sandwich, what that tell us about our resistance level? It's not there anymore. We're now in wave 3. So this is what everybody tries to learn. Your option choices. Which strike price should I be trading? And which time frame? That all comes back to what is your risk tolerance? Now, if you can only spend a few minutes each day in front of the screen, you probably want to be trading a little bit longer time frames. And you might not want to be trading as risky a stock price move. That means you might be trading in the money calls, because they're going to be a little bit more conservative. And if you can't sit there and watch it every day and get ready to close it out on the first signs of selling until you get to your screen later, you might want to go out a little bit further. That let's see, tomorrow is expiration. Say I'm ready to buy something tomorrow. Depending on how aggressive I want to be, I might buy a weekly call that expires next Friday or the Friday after that. Or if I want to be more conservative, I just buy an April call that expires the third Friday of April, which gives us what, 4 or 5 weeks to watch it. So that is based upon everybody's risk tolerance. So every time you pull up your what they call the options ladder, you can either be going after the monthly or the weekly, depending on what time frame you want to trade. The next thing you want to figure out is, I think this was Apple today, what calls, now this is the March, so you probably wouldn't be doing this one. Which ones do you want to go after? Now, obviously, the higher the price, the less you're going to pay for it, because there's more risk that it's not going to get there. So that becomes a part of your own education, or you can set up a spread. Oops, this is where you might take a look at a spread on a stock where you're buying the 25s and you're selling the 28s for $1.10, That means if it moves up to the $28 level, your $1.10 has now moved to $3. How often should we watch a weekly option trade? Oh, Geo, I would, yeah, the closer it is, the more I'd want to keep paying attention to it. So that goes back to the factor that if I'm buying something that's 4 weeks away, I might just buy the calls or puts. On a shorter time frame, if there's 2 or 3 weeks until expiration, I might do debit spreads, and if it's in the final week of a expiration, I might do a credit spread. So, oh, this was the one for, so let's say we thought, I just went on a small mental vacation. Say we want to buy Apple calls, a call spread. Well, we can set it up very easy, showing that if we buy the 177.50s and sell the 182.50s, it's $2.30. Now, I've just got kind of a rule of thumb that if this is a $5 spread, I probably don't want to spend any more than $2 to execute that spread. Now, that's just my own parameter. Somebody else may say, oh, I want to take this because I want to see if I can make this move to $3.30 and then close it out. Why pay a premium when you can just buy the stock? Then all you have to do is set a tight stop at what the premium would cost. Gary, if I'm buying a stock that's trading at $50 and I'm going to just hypothetically say tomorrow I'm buying a stock that is right at $50. It's opening a little bit positive, so I want to buy the calls. So I'm going to buy the April 50s. I'm going to just pick out a number for $3. Well, for $3, if that stock goes up to 60 between now and expiration for April, I've got $3,000 exposed, and if it goes to 60, my $3,000 goes to $10,000, or I've made $7,000 on my $3,000 purchase, which is about 230%. On the other hand, if I bought the stock 1,000 shares for $50, I had to shell out $50,000. And if it went from 50 to 60, I've made $10,000 on my $50,000 purchase, or whatever is that? $10,000 for 20%. So I've made 20% with $50,000 exposed versus made $7,000 with $3,000 exposed. So the reason you're buying the options is to get much more leverage. Now, on the other hand, let's say you think that $50 stock could either go up tremendously or there's a risk it could go down tremendously. So if I bought the 10 options for $3,000 and the stock all of a sudden crashed down to 40, how much money have I lost? Well, if those options go to zero, I've lost $3,000. If I bought the stock for 50 grand and it went to 40, how much money have I just lost? I've lost $10,000. So the reason you're using options is for a couple reasons. Obviously, to get much better leverage, number one, and number two, if you're trading a volatile situation, your loss using the options are going to be much smaller than if you went out and exposed a lot of money to buying the stock. You lose it when you sell it. It could still recover. Yes, That's the risk reward for using options, because you're only buying something that has a specific time frame. Joe, yes. That's probably a question I don't even know. All right. So this is what we're looking for. Where is the obvious breakout? Right here. So if we were buying here, where's our first projected target? This level. It may or may not get there. If it breaks out from here, what's that tell us? That we immediately know we've got a pattern breakout. If we see something like this, we start taking our profits. Where do we buy back? Well, notice what this one did on this day. Did a doji. If it opens positive, what's it telling us? Telling us we got a bobble breakout, and that if it opens positive, it's got a high probability that it's going to move positive, which means our JHook bobble breakout is in progress. So very simple parameters. If this opens positive, what's our doji rule? Tells us we should be trading positive. If it's trading positive, what's it tell us about our pattern? We've got a successful pattern, a bobble breakout. If it does open positive, what should be the magnitude of this move right here? Usually the same as this right here. So we know what should happen with a high degree of probability. Now, if it opens here and closes down here, what do we have? We've got a sell signal, a bearish engulfing, bearish left-right combo. Right here at the level it's supposed to be breaking out. What's that tell us to do? Close out the position immediately. So everything we understand or know from what a pattern should be doing helps us make decisions. But if we know if this is a JHook pattern, we also know wave 1 and wave 3 are going to be equivalent. So how do we mitigate our risk? Well, if it breaks out right here, we might be buying these calls and selling these calls up here, or selling these calls, depends on which ones makes the most sense math-wise. I'm reading what Rick is. Do you ever trade stock anymore, or are all your trades now in options? No, John. Depending on the nature of each, I guess each investor, number one, or the trading account. If you've got a $1 million trading account, you're probably trading much less options. That you want to be a little bit more secure and buy the stock. If you've got a $15,000 trading account, you might be much more inclined to trade options, so you get much more leverage. So I trade both. I trade all. I trade options. I trade stocks. I trade futures. All depending on which account I'm trading. Oh, okay, Rick. All right. So on this one, if we already have a preconceived expectation of a pattern, that gives us a lot more variables to work with, where we could either be doing a spread, or if we think this is a big magnitude move, just buying calls outright. Whatever is the best for the time frame. So the other day, you could see how the scoop pattern was setting up. This was one of Nora's trades. She made a 1,160% gain on that trade. So what was her risk-reward factor? She was buying something way up here, way out of the money for mere pennies. So that when it banged up, it went, yes, that's what we were all trying to make, or that we're going to have a party at her house. I think today they said she was in Baba. There was your moving up. There was one resistance level. There was another resistance level. There was your bullish harami telling you the selling had stopped. That if it traded positive, you had a breakout. So if you were buying right here on the end of yesterday, got this pop today. So when we can see that the market is setting up like this, the benefit we have with candlestick charts is we can anticipate what the next price move may be. That if they start coming back up to this level, if it breaks out, what do we want to be looking for? We want to be looking for stock prices that are just breaking out. So when we're doing option trade analysis, you put in all the stars in alignment. When you can analyze what the market is doing in general, we can use our signals and patterns to tell us which ones are just about ready to break out. And we can also project targets based upon each signal or pattern. So the graphics of candlesticks, the reason they are so consistent is because human nature works the same way time after time, year after year. I don't know what strike price you did on Baba. Yeah, I'm sure it was way out of the money. So what's the strategy of buying way out of the money? As you can see in some of the ones that are working for Nora, if they work, you make big, huge gains. If they don't work, you don't have very much money exposed. Your losses are fairly small. All right, so now we're going to be doing trainings on a consistent basis. Bill Johnson's got a package where the great thing that Bill does is he teaches not only what trade setups to look for that are most effective for that price move, but when that price move changes, he shows how you modify that strategy so that you're consistently protecting your profits and still taking advantage of more upside gains. Also, we've got trade wins. We've got this package that you probably want to take a look at. Our Pivotal Cash Bonanza. This is trade wins taking my criteria, my buy signals and breakout points. And you don't have to calculate which strike price, which expiration date. They've got that all calculated. So basically you're giving them, or you're there, you sign up with them and they will give you the Becky just put the link on. They will give you the criteria or the picks to go after. So that means they're picking out situations that are not only high probability trade setups, but they've also calculated which candlestick trade option trades you want to apply to that trade. So you don't have to sit there and calculate, is a call spread best here, is a iron butterfly, all that sort of thing. I don't trade after hours just because Sophie, if you click on that link, that all those numbers are in there. That'll break it down for you. All right, so anyways, we are going to be concentrating on options because as you can see in this market, the volatility is getting much greater. That is not a deterrent. That is a benefit when you're a candlestick investor because no matter what the volatility is, you're going to be able to identify what investor sentiment is doing and then take advantage of much bigger price moves. Rick, that could be But if you put $500 and make a $1,100 profit or 1,100% profit, it doesn't take very much of those to make a very good living. Okay, well, that pretty much took up our hour. I guess we could do this. Let me, Jim, I'll go ahead and close this out. We'll spend a few minutes on the ones that look attractive as far as charts are concerned. Market or wait? Bob, I usually wait because I've found that probably 90% of the time, whatever price movement is occurring after hours or before the market opens is usually quickly offset by as soon as the market opens. Remember what the market is. It's the cumulative knowledge of everybody buying and selling during a particular time frame. So if everybody means the market, which starts trading at 9:30 in the morning, that means whoever's ever buying and selling before the market opens isn't everybody. It's just a few people that want to get in early for whatever their reason is. Now, when does the analysis of the pre-market trading become important? Usually about within 5 minutes before the market opens. So if I'm ready to buy something based upon a positive open, and I see that pre-market it's trading up 30 cents from where it closed the night before, it's already on my alert list to get ready to watch that one closely as it opens up to see which way it's going, and I'll show you one that kind of applies. So right now, as we can see, we're in this wedge formation in the Dow. Do you wait a while after market opens, like an hour? No, maybe 90 seconds. Because there's the old adage that says the amateurs buy during the first hour, the professionals buy or sell later in the day. Well, with candlestick analysis, we don't give a hoot who is buying or selling during that first hour. We're just seeing what investor sentiment is usually doing, or doing on a high probability basis. How much time do you wait between open and execution of a trade because it opens in the right direction? Sometimes it's 30 seconds, sometimes it's 90 seconds, sometimes it's 5 minutes. Want to make sure that the buying is there. Now, there's a lot of times where people say, well, it opened up positive and I bought it immediately, but it immediately started backing off. Well, that's why I wait 90 seconds. Once it opens, I want to see if they're still buying. So if it opens up at $50.23, and I think the next move is to $60, it doesn't matter to me whether I buy it at $20.20 or $50.23 or $50.28 or $50.35. I want to make sure it's moving in the direction that I expect it to be heading. Adrian is a different group of professional investors that do take my analysis, my signals, and then they apply what they think is the best option strategy to go with those signals. Do you pay close attention to level 2? No. I pay more attention to my 10-minute chart. Let's say, for example, we think the market is in an uptrend, but the next day it opens down and the Dow goes down 50 points. Well, if the Dow is trading down, we're expecting it to go up, and the stocks that we were ready to buy were sagging a little bit, we're not going to do anything. But if the 10-minute chart shows that the selling has stopped and now starting back up in the direction that we expected the market to be moving, yeah, if it does a buy signal off my 10-minute chart, then I'll start buying. So level 2 really has nothing to do with it. Yeah, I would rather see what the 10-minute chart is doing. No, I think this is Trade Winds, the group from Trade Winds. So essentially what we're doing is we're combining the correct trade with the correct trade strategies just to improve your probabilities. So I've got a lot of people that say, well, I want to trade some, but I'm not real sure of my trading skills yet. I suggest to them, use their service to trade what they're trading, then keep learning, and your learning process will be watching what we do in the options room and or the our chat room each day of when to be buying and selling. Because I always advise people, don't get stuck into completely depending upon a trading service, because if that trading service goes bad, you're right back where you started from. You don't know anything. So I suggest to people, use their service if you want to be trading. When they put on a recommendation, go right to being recommended. Same thing with when I put out 2 or 3 stock picks every day. It's not so you just have stock picks, it's so you can look to see what the rationale was on that video to make that a viable purchase, what the parameters were that were setting that up to be recommended. Oh, Ron, I hate to say this, but I don't know. That's another thing that you can ask Abraham. Okay. All right, so here's a couple things that just need to be pointed out. Look what's happened on this one. This one, we saw the breakout. We saw the pullback. This is what you call your methods rising. Notice when they pulled back, they couldn't get this to close back below the open of this candle. What's that tell you? The bears ran out of steam. When they gap it up and take it back up, that's your methods rising, telling you there's more upside. Now, this is the type of thing you want to identify, because that not only tells you you're in the right direction, well, it does tell you you're in the right direction, but occasionally you get in a situation like this. But if this stock opened at 825 and had a high of 2166, everybody always asks, well, what should I do up here? This is very simple. You go to your 10-minute chart. You start seeing sell signals. You might say, all right, I'm away from my 10-minute T-line. Might even get a, whoops, that's the 30-minute chart, I'm sorry. That's the 15, this is the 10-minute. There's our 10-minute chart. And there's it closed back below the T-line right here. That's where I might start taking profits. Now, if I want to get a little bit more fine-tuned, I go to my 5-minute chart. Kind of the same scenario, that if you start seeing selling on the 5-minute chart, and that coincides with the selling on the chart, that's where you want to take profits. Why do you want to take profits when you see the 10-minute chart and start trading back below the T-line? Because what's our number one criteria for when to take profits, or one of our major criteria? The further away you are from the T-line, the higher the probability it's going to come back down and test it. Secondly, if you're buying a stock at whatever this is, somewhere down in here at $6, $7, $8, $9, and it goes to $21 or $22, whatever, most people are happier than a 10% return on their portfolio in a year. If you're making 150% on a trade in one day, what do you think is going to happen up here? Unless there's something major going on, like a buyout, and they start selling it off, take your profits. You can always buy back if the buying starts back up again. They must call it a bobble because it acts like a fish pulling your bobber down underwater and then back up again. No, we call it the bobble just because when it hits a resistance level, it kind of bobbles around for a little bit. So anyways, ADAP. Look what's happened here. Big breakout. Now what is this up here? After a fry pan bottom breakout. What do we expect coming out of a fry pan bottom? A very strong price move. Here's another case where if it broke out and it came way up here during the day, anytime you start moving that far, that fast away from the T-line, go to your 10-minute chart. What happened up here? Look how far away you were on the 10-minute chart away from the T-line. Where was your stop? Probably right here, or worst case scenario, right here. So did you get out at the exact top? Not if you waited here, but you got most of that profit for the day. What I've discovered, and this is what I've shown people in the options room when you've got a big price move, if you've got a 10-minute chart, and I trade this the same way you trading futures, that if everything's good, everything's good, everything's good, the first time I see selling, I take off at least half the position, if not the full position. Because once they start selling, what's that tell us about our uptrend? It's usually over. And what's the worst case scenario? If it comes back up through this level, you can buy again. If they can't get back up through that level, that means they overshot it, and now they're back into the range of where they should be. What about using a trailing stop? You can do that. But if I'm sitting here watching this, then all right, I'm still above the T-line. Oops, I'm still above the T-line, but now there's a little danger. I'm moving away too fast. Now I've got a potential sell signal, a doji. Where am I on the 10-minute chart? So if I'm sitting here watching this, I'm thinking to myself, all right, if they come back down through the open of that doji, I want to close it out. Because if they did, what do I have up here? I've got a sell signal. Okay, so let's see some of the other ones that. So we did the same thing made some big profits last week on ZSAN. Where was the buy? Look at our bobble breakout. Where was our sell? Look where we were compared to the T-line going to our 10-minute chart. So this isn't to say that we catch every big, huge price move. This is to say that we can find situations where the probabilities are pretty strong that we're heading in the right direction, looking for setups where we can be in those big price moves. So today we recommended CATO, C-A-T-O. Why? Because there was our bobble. If it opened positive, what was happening? There was our doji rule. What was likely to happen? The magnitude of this candle and the magnitude of this candle would be the same, which would imply that our JHook pattern was in progress. So where's our next likely target? probably up here to the 200-day moving average. Same thing on the sell side. Anytime you see that big gap down, that means there's been a drastic change of investor sentiment. So we've been short Roku for a while, because notice what it hasn't been able to do. It hasn't been able to close above the T-line. TLRD, what's that telling you? There's been a major change of investor sentiment. So what do you want to be doing with this one? You can start shorting it on weakness with the anticipation that your next target could be down to the 200-day moving average. And G4. We've been long G4 until today. Because what did we want to see? That it didn't close below the T-line. Where was our stop? Just below the T-line. Because logic says when it was trading up, couldn't get through the 50, and they came back down through the T-line, which way were they going? It was time to take profits. Notice our kicker signal started our uptrend. So if we close this out, a lot of people ask, is this now become a sell signal or going short? Again, that's up to each individual. In this case, sometimes you can see a downtrend. In this case, it was flat. Now they're failing. Where's your next likely target if this starts trading weaker? Probably back down here to test the lows again. Yeah, there is a logic in the market. Options nerd. That is, we're in a wedge. So right now it's telling us there's no direction. But what do we want to be doing based upon knowing there's a wedge? We want to see whether it's going to break out this way or this way. That may mean for the next few days, yeah, we're not going to see anything of any great magnitude. But we had the same thing that told us we weren't going through this level. At kind of an evening star, left-right combo. Now we're sitting right here on the 50 and the T-line. Let's make this bigger. So what can we assess from this? Well, if they bounce it back up, that means we might have a JHook pattern with this one taking us up through this level, taking us up to fill this gap up here. The transportation index was even more defining in that look what happened up here. Kind of had our evening star signal right here at the 50, which acted as resistance before. That told us that if they started selling this off instead of keeping it up above the 50, then we're back in a trading range until they can break out. I am not seeing the right edge of the chart. Jim, can you help him? Usually I put the picks in sometimes late at night. It'd be anywhere from 5 o'clock in the evening, anywhere up to 11 o'clock in the evening. And then, so if you come in first thing in the morning, you should see it. Yeah, nobody sees the right edge of the chart. It's tomorrow. Now, we had also been short in the options room in overstock. Because you could see the trend. You could see the support level. You could see the failure. Today they announced earnings And after hours, anybody see where it's trading after hours? I knew it was down here close to 41 or so. Was that 41? All right. So the puts that we had, because it didn't look real convincing, I sold half my put position right here. But the other half is still going to have some very big profits. We had good profits in this position. It's going to be much bigger, hopefully to the downside tomorrow. So if it opens down here, where do you think the first likely test is going to be? Right here at the 200. CASA. Notice when it came out of this fry pan bottom, it broke out nicely. So what is, oh, Tim, there's no congrats. I just do what the charts tell me. Again, this is from years ago, being the worst investor in the world. And when candlesticks came along, all I had to do was figure out to do the opposite. That I was the one usually buying exuberantly at the top, and I was the panic seller at the bottom. But all I had to do was just turn it around. And ever since then, I've been pulling money out of the market consistently. Enough to make a very good living each year. So look where you are now on CASA after the fry pan bottom breakout. Look how far away you are from the T-line. I'd have a safety stop right here. And if it traded higher tomorrow, I'd be trading off the, I wouldn't say very rich. Let's just say I live comfortably. So if it trades higher tomorrow, you flip to your 10-minute chart. There's a fry pan bottom on CHFS. Do you want to buy this one tomorrow? Well, if it opens positive, what's our doji rule? They're probably trading it positive. And what's it telling us? That this fry pan bottom is working. Roku we did. Oh, Crisp. Crisp was one that when it broke out through this little wedge, how long do we keep it? Until you see a sell signal and a close below the T-line. What was giving us the impression that we might start seeing profit taking? Look where they gapped up. Anytime you see a gap up in the overbought condition, start watching for your sell signal. What's happening to XLM? Nothing. You just stay short. JNCE. Another one. These are very high probability trade setups. You can see there's kind of a downtrending channel, even more defined right here. And where are we right now? Wave 1, Wave 2, in Wave 3. Now you've had a doji today. You're not quite in the overbought area, but where would you put a safety stop? Right here. They have enough juice to come to the downside through that level, close out the position. Somebody pointed out Humana today. What's Humana doing? There's your wedge. So what do you want to be setting up for? If they trade up through this level, you want to start buying calls or putting on some sort of strategy. CNAT we use as an example because look what happened at this trend breakout. And how did this trend breakout start? Is your best friend signal, a doji gap up. Just that alone was a good buy signal. Then the fact that you could add that it broke out through this downtrending resistance level gave you that much more impetus to say that Smart, same scenario. What is this up here? Profit taking. If you had been kicker type signal, opened here and closed here, fry pan bottom, something big obviously happened. So if you went to your 10-minute chart, look where your first sell signal was. On your 10-minute chart, look how far away you were from the T-line. The first sell signal, you close out the position because the probabilities are pretty strong that they're going to pull it back. You could always buy it back. Oh, is that they the ones on the wheat research? Whoops. Because we've been short wheat, because it's still trading down below the T-line. Too late to buy. Oh, which one was that? On Smart. No, what's your process? If this is profit taking, if it opens positive, what's it telling you? The profit taking is over. So if this opened positive tomorrow, it should be trading positive. So where's your stop? You put your stop right here, because if it opens positive and has enough selling strength to come down through there, they're not buying it anymore. So the reason you want to put stops on is very simple. If you're buying based upon a pattern breakout, and when they open this and started trading positive, what did that tell us about our resistance level right here? It wasn't acting as resistance. When it came back down through the open, what was it implying? That there wasn't any strength here. You close out the position, because why were you buying in the first place? Because the pattern told you it was breaking out. When they came back down through the open, where were you? You were back into the trend channel where you didn't want to be. So if you, remember, put in your mind that 1/3 of your trades aren't going to work. If you're buying here or buying here or buying here, and then it comes back down through here, you don't have to beat yourself up. You just say, this is one of the ones that didn't work. Close me out. Let me move on to something else. It's better to take that small, quick loss than to sit with something as a bigger loss and sit there trying to figure out what to do. Same scenario today on cattle. Cattle opened and started trading positive. I didn't buy any because I didn't have any money to buy any, but would have been a buyer. But as soon as it came back down through the open, it would have told us the buyers aren't there. You close it right back out again. That trade setup didn't work. Let's see. I guess I've gone through all of them. Okay. Let's see. EUA K8. EUA M8. Today the euro produced a closing Marabuzzo. Yeah, I wouldn't make the Marabuzzo anything relevant. What I'd look at more is that this is just kind of a sideways drifting chart. That at best you could be going short, but you got to remember this has been acting as a support level for a while. So a Marabuzzo doesn't really make that big a deal. NVIDIA, slow. So where is the breakout? You can pretty much draw a trend right through the tops. That's where you're watching to see if they can break out to the upside. Okay, on yeah, HRTX, yeah, I feel a lot more comfortable if they open this lower. NASDAQ had a hard time getting through this level. But you're sitting right here on the T line. It'll be important to see how they open this tomorrow. If they trade it below the T line, now you can kind of project that you might be in this uptrending channel, which means they could be bringing it back down toward the 50. A Marabuzzo is when they close it right at the end of the candle. This is kind of a Marabuzzo right here. Notice they closed it right at the high. That's usually an indication that if you're in the overbought area, that that's your last gasp. And usually a Marabuzzo is the opposite of the bearish candle. If you're short, where are you covering your shorts? Right up to the very last second. Yeah, not so much. I would anticipate you might be in this type of process where it comes up, sells off, comes up, sells off. On which one, Brett? Oh, where it opens tomorrow. You know, when you get up in the morning at around 9:20 is when the relevant pre-market futures come into play, because that's where everybody's coming in and making their decisions. Whiting, Hicker type signal, you're still in a 45 degree as long as you stay above the T line. All right, well, tonight we just wanted to get the point across that there's lots of places that provide high probability breakout situations. Can't remember which one, but just for example, today's recommendation on Cato was based upon a high probability trade setup, that if it opened positive after a bobble breakout, that your doji sandwich would confirm that bobble breakout, telling us our next target is up here. All right, so with that, you want to definitely take a look at the Pivotal Cash Bonanza program. It's well worth the money, especially for those that can't sit and trade all day long. They're at least going to put you into situations where you've got two things going for you. They've used candlestick signals to indicate when to buy and sell, and they've investigated to see which strike price, which expiration date, which strategy is the best, so that you don't have to do that calculation. All right, with that, everybody have RC, we're probably going to have Bill Johnson start coming in. And right now, I can say offhand, there's probably 5 excellent traders in there that if you just follow what they're doing, you're going to hit some big licks. So that's the advantage of these chat rooms, is that you're not reinventing the wheel. You're listening to people that use the charts for their analysis, and then can show you what strategies are the best to take advantage of it. All right, everybody. We'll see you bright and early tomorrow in the chat rooms. We'll see you then.